Good afternoon, and welcome to Juniper Research's Top 10 Fintech Predictions for 2021 webinar. I'm Nick Maynard, Lead Analyst at Juniper Research, and with me today I have Lead Analyst James Moore and Senior Analyst Susanna Hampton. So if we have a look at today's agenda, we're going to first review how accurate our 2020 predictions were. Then we'll be talking you through our top 10 fintech predictions for 2021, and then we'll conclude with a question and answer session. But to begin with, here's a brief introduction to Juniper and our top 10 fintech predictions. So Juniper Research specializes in identifying and appraising new high-growth market sectors within the digital ecosystem, and we've got a particular focus on the fintech and payments market. We provide market research and content across a really big number of technology markets, and these research reports form the basis on which our expert analysts make these predictions, like we'll be seeing today. So, looking at our overview of what we're going to cover today then. So, this is our second year of publishing a specific set of fintech predictions, and this is alongside publishing a long-standing technology trends list. So, in order to form the list, we look at a number of different metrics. Firstly, we look at what legislative changes are planned, what products have recently launched or are planned for launch, and which technologies are anticipated to have the highest disruptive potential. Our analyst team then whittles down a long list of potential trends, which are then ranked on their likely overall impact in 2021 to give us our set of top 10 fintech predictions. Now, for this webinar, we've put together a couple of slides on each of those trends. For each trend, we'll be exploring four key aspects of it. What's the opportunity? Why 2021? Who will benefit? And lastly, what's the prediction we're making? We've also included the title of relevant Juniper Research reports if you want to learn more about any particular topic we cover. So before we go through this year's predictions, I'd like to take a look through a few of our predictions for 2020. The COVID-19 pandemic has clearly had a large impact on the fintech market, but we were still accurate with many of our predictions for last year. In fact, the fintech sector has seen a significant acceleration from the pandemic rather than the more profound changes in other areas of the technology markets. So some examples there. Firstly, we predicted that contactless cards would reach scale in the US, and we've seen that achieved with large bank rollouts of contactless cards. And we've seen a lot of usage as a result of the pandemic as one of those drivers. We also anticipated that QR code payments would reach scale in some emerging markets, and there are signs that that is occurring. And we also anticipated that instant payments scheme momentum would build into 2020 with use gaining adoption. And it did do that. And we've seen launches such as PIX in Brazil that are set to sustain that rapid growth. So, what does the next year hold in store? Now, over to my colleague James for number 10, and that is that digital onboarding will mature rapidly in the wake of the pandemic. Over to you, James.
Thank you very much, Nick. With in-person interactions difficult, if not impossible, for most of the year we just had, customer onboarding has had to rapidly move online. It needs to have been adopted by an awful lot of businesses, particularly in fintech and financial sector, if they want to survive in a digital-first or digital-only environment. Last year has also shown up any flaws in any existing digital onboarding systems in stark relief. This has forced financial firms and anyone else that requires a full onboarding process to iterate rapidly in order to survive. This has produced an environment where not only have we seen adoption of digital onboarding skyrocket, but we have also had a very rapid feature build out, bringing what is now a vital market to a very swift maturity. This has been helped by a regulatory environment that has know your customer requirements top of mind in many instances and has been accelerated in Europe, particularly thanks to a financial ecosystem that supports API-enabled data sharing. As digital fraud prevention becomes more important as well, digital onboarding will only increase in importance over the course of 2021, which we will believe will be a key year for digital onboarding, as many consumers are now accustomed to a digital-first interaction environment. And as the pandemic recedes and people start to go out into the world a bit more and perhaps look for the interactions that they used to have, they will have already developed habits around digital interactions and digital first interactions, which are unlikely to go away. So, finding the tools for more efficient and secure digital onboarding will be the number one way of ensuring a steady new business growth for many financial institutions as consumers want to engage banking, but maybe either unable or unwilling to do so in the wake of COVID-19 because of those habit changes. And so, habits developed over the pandemic period will become ingrained, and businesses that can offer superior onboarding experiences as well as digital services have a real opportunity to stand out from the crowd at a point where digital is both expected and necessary. And in addition, in a forthcoming Juniper Research survey that we've recently conducted, it shows that over half of consumers in the US and the UK who are looking to switch banks are likely to switch to a digital only bank. So we can clearly see that this shift towards digital onboarding will be key in appealing to those consumers looking for those particular experiences. So those businesses that cannot get the onboarding process right will also face a steady churn of potential customers away because their expectations of onboarding will not be met. And the way that those expectations will be shaped will be solidified in the coming year. A key beneficiary from the process of digital onboarding becoming mature will be consumers as onboarding processes become smoother and online onboarding services already involve less barriers than their offline equivalents. This will make the whole process of switching financial service providers much easier, allowing consumers to take advantage of the best financial services deals for themselves. We also expect technology providers to benefit, those that offer identity verification services and, in some cases, hardware for the digital onboarding process, in particular, going to take off. The maturing of the onboarding process will bring them new customers, as well as enable them to offer new features that clients are likely to want in order to differentiate their customer journey from that of their competitors. And as a result of more digital onboarding in the coming year, we expect the use of digital identities and digital identity apps to accelerate throughout 2021. However, these solutions are often operating in highly regulated industries, and so we expect the biggest successes to be where there's regulatory support for these forms of identification, such as the adoption of WeChat digital identities in China and the use of Bank ID in Norway and the various other forms of digital identity that are already part of the banking sector across various parts of Europe. This means that Asia Pacific will have some of the biggest deployments, and India and Australia, in addition to China, already have quite well established partnerships for civic identity, and they can be leveraged in the onboarding process far more easily than they can in other parts of the world, particularly North America and large chunks of Europe. And now back to Nick for trend number 9, which is that AI powered innovation in user experience will be critical to banking success in 2021.
So, 2020 saw some big changes in the banking market, and those were mainly fueled by the pandemic. We saw a significant acceleration of the transition to digital banking. And with people unable or unwilling to access branches during lockdown conditions or shelter at home orders, the emphasis for banks has shifted naturally to their digital operations. The challenge with this is that many banking services are pretty comparable broadly in price terms, and the differentiation between those banks is quite weak. Now, with renewed pressure on the digital channel in this way, we see 2021 as the year where digital banking differentiation becomes critical, with that competition intensifying. And that means AI powered user experience has a really important role to play here. Now, with services essentially commoditized at this point, user experience still is becoming that critical differentiator. Digital only banks have flourished by offering insightful and simple user experience designs. AI is very important to this as it can power insights into spending and elements of customization of the user experience, which can differentiate services very effectively. These tools are already important tools, so this isn't necessarily an area where new tools are being created. Some of these tools are already successful for digital-only banks and are a major part of their appeal, with some of these traditional banks struggling to implement them effectively. And those banks have been limited by their legacy infrastructures, such as their core banking systems, which have been made leveraging analytics more difficult. So, why is this going to happen in 2021? Now, the growth of digital banking and the pressure from digital only banks means that it's a more competitive market than ever before. And therefore, that need to differentiate is very, very strong. And digital only banks have not disappeared, as many predicted. Digital only banks, in some cases, they furloughed staff, and in some other cases, they've made redundancies. But their funding is still pretty strong, and they continue to acquire users. And that puts additional pressure on those traditional banks, as that competition is here to stay. That's not going anywhere. And customer expectations will be an important driver this year. Users now expect more from their bank, and differentiation on price, as we mentioned, is difficult in this market. The increased use of digital this year, plus those digital-only banks becoming more well-known, has increased those expectations. And insights, really, they've become a part of our daily lives in many aspects. Smartphones are giving insights on usage times and elements such as this. Insights and analytics are therefore becoming part of users' actual expectations rather than those nice-to-have features. And finally, for several years, banks have been working on their legacy infrastructures. They've been updating core banking systems and related areas. And that means that they're now in the position to alter the fundamentals of their digital offerings. And they can do that without incurring problems throughout their technology stack. So that's been quite a challenge for them. But we've seen quite a lot of progress in that regard, which is really important. So who's going to benefit from these changes to the banking experience? We see two sets of stakeholders are going to benefit from this the most. And firstly, traditional banks. By offering a more compelling user experience, they'll be able to boost that customer retention, which is so critical for them in the highly competitive market, and even potentially acquisition if new features that they're developing are showcased effectively in marketing. Banks can minimize this by marketing campaigns which highlight how progressive their new technology deployments are. The second main group is the users. So for them, these changes in how digital banking works increase the value proposition of holding that digital banking account. They're able to gain deeper insights into their spending versus their income, and they can make more informed decisions about their money management, which has been more important than ever during the current situation. Greater automation will lead to solutions such as automated savings pots, and that can be of a real benefit to users. And there has been a lot of desire for sort of elements that can improve financial health in the context of the pandemic. So we think that's really important. Third-party vendors are also going to benefit here. Banks are going to leverage outside technology to boost that analytics capability. And banking software providers will compete to provide the best value-added services they can, whilst keeping the implementation costs low by leveraging cloud and modular trends in core banking, which are really strong. So to summarize, our prediction is that traditional banks will evolve their digital offerings using AI to create a better UX, and that will increase their digital value proposition significantly. That's going to lead to a situation where traditional banks are better equipped to provide stronger competition to those digital-only disruptors we mentioned. And there'll also be better data-driven insights for users, and that's going to make it a more positive experience overall. This is going to lead to sort of a technological arms race of sorts, where traditional banks and digital-only banks compete to provide the most advanced user experience possible. And that ultimately can only benefit the end users of the service, which is really important. So now we're on to number 8, which is with Susanna, and that is the rapid rise of social commerce and the need for new payment capabilities. So over to you, Susanna.
Thanks very much, Nick. So what's the trend here? So in the past year, enabling omnichannel shopping and payments within e-commerce has become absolutely crucial for merchants as a result of this COVID-19 pandemic. The omnichannel experience with e-commerce is now being expanded further through new developments such as social commerce. E-commerce now has real potential to move towards increasing the availability of physical products in real time, linking brands to their consumers in a much smoother way. For example, providing a clickable link direct to an outfit or an accessory that a celebrity is wearing. This is already proving to be a viable marketing channel to the likes of Instagram influencers, but there's a great deal of potential for this to extend even further into direct sales. Many of the major social platforms have recently introduced shopping functionality. For example, Snapchat's shopping channel Shop and Cop, which was launched 2018, and it offers users limited time deals on a range of items, allowing them to purchase within the app rather than being redirected to a retailer's website. In 2020, Facebook launched a new feature called Shops, which enables businesses to display and sell their products on the platform. In 2019, Instagram launched Checkout, and this enables users to tap to view a product from the brand's shopping post, select options such as colour and size, and buy the product without leaving the app. And in 2019, TikTok began beta tests, allowing their influencers to embed social commerce links in videos on the app. So why 2021? Well, in recent years, there's been a significant move towards m-commerce. Shoppers are increasingly prepared to make purchases via their phone. Mobile phones are becoming ubiquitous, and their ability to reach people at any time make them the ideal way for businesses to engage with their customers. Shoppers are increasingly seeing their phone as a convenient way to buy, and the ability to link directly to products and purchase them through a social media app rather than being redirected to a different site makes the shopping experience far more convenient. So with the growing popularity of social media apps and these platforms offering an increasingly embedded commerce experience, 2021 is the year when we're really going to see this trend taking off. With the proliferation of social media influences and the powerful potential for direct sales to be driven through their recommendations, growth seems inevitable here. So who's going to benefit? Well, for merchants, using social media platforms to sell can potentially offer a huge boost to their sales, particularly within the younger demographic. It offers an increased number of channels across which they can sell products. For brands, although it represents a challenge, unfortunately, due to their inability to establish a permanent presence through these channels. The transient nature of these posts on these platforms means that tracking and achieving conversions for brands is quite difficult. For consumers, as we observed in our recent e-commerce payments report, the digitisation of commerce and of the payment experience as a whole is shifting consumer expectations in terms of service. Shoppers are expecting the whole transaction experience to be seamless, more integrated with the whole commerce experience overall. And so this shortening of the shopper engagement and purchase cycle that is offered by social commerce fits really well with the increasing consumer demand for transaction speed and convenience. So we anticipate that this line between e-commerce and social media is going to become increasingly blurred. With a huge estimated active user bases of social media apps, so around 1 billion in the case of Instagram, approximately 800 million for TikTok, and more than 300 million for Snapchat, there's clearly a high potential for the further rollout of e-commerce features here. As a result, supporting integrated payments for social commerce will become an absolute necessity, and we expect that the number of smartphone users purchasing goods using their phone will also continue to grow. In the future, we may just see a move towards the complete disintermediation of merchant checkout process. For example, a company like Netflix linking products directly rather than consumers having to go via Amazon or similar. Now I'll hand you back to Nick for number 7, which is transparency and speed in B2B payments to rise rapidly.
Thanks very much, Susanna. So on to number 7 then. So what are we talking about here? It'll be a surprise to absolutely nobody that B2B payments have been a complex and a difficult task to manage for many years. And accounts payable and accounts receivable processes have consumed an enormous amount of time and resources at large corporates. B2B payments landscapes have only become more complicated over time. And you can see that in the diagram to the right, that there's a huge amount of complexity there. There are a huge number of different elements that make up this market, and B2B payments are fundamentally complicated. Invoices have a multitude of different variables, amounts, addresses, payment terms, and that's just sort of scratching on the surface. What's making this a challenge is the level of manual work that this currently entails in terms of making payments, reconciling payments, and all sorts of different ramifications of the process. Now, we believe 2021 is the year that this complexity will begin to be resolved with new injections of transparency and speed into these B2B payments processes. Fundamentally, we believe that the degree of automation being leveraged in processes will significantly increase, and that's going to ease resource burdens across the area, and that will reduce frustrations for both suppliers and buyers in the B2B payments market, which is really important. So obviously, we've outlined the challenges here. A lot needs to happen here. Why do we think this is going to happen in 2021? So fundamentally, 2020 was a game-changing year for B2B payments, and there have been many unique pressures applied to the market. It witnessed the development and initial deployment of technologies that have the potential to revolutionize the way payments are made and managed, which is really important. COVID-19 has had an important impact here. Many businesses across the world have had to operate fully remotely for the first time, which has been really challenging for them, as well as a number of other effects, and those are numerous. It's exposed creaking payments processes and the level at which manual inputs are still required in those accounts receivable and payable processes. And a key development enabling this change has been the creation and deployment of instant payment schemes. Now, these services, which allow for payments to be transacted within 10 seconds, have implications far beyond just speed. These systems are generally built upon the ISO 20022 standards, and that's a global standard for improving financial messaging, among many other things. And that critically in B2B payments allows for additional remittance information to be provided with payments, and that can really supercharge how automation is used. Instant payments are also a lot easier to trace, and that enables a big amount of transparency in the process. We've also got virtual cards, and virtual cards are another way in which payments are becoming faster and more transparent in the B2B area. Remote issuance and management have emerged as key capabilities in the wake of the pandemic, so that's really important. And also, we're starting to see automation tools gaining popularity in the market, and a lot of ERP systems are constantly building more and more API connections that can increasingly simplify the way systems interact and further reduce that manual work requirement. And ultimately, these combination of factors, we think that 2021 has the right drivers and the right technological base to see those radical improvements that the market needs. So we're identifying some pretty fundamental changes here. We're going to see several beneficiaries of this. Obviously, businesses will be the largest beneficiaries, and simplified, transparent, and automated B2B payments processes will mean ultimately less resource needs to be spent on manual work, and that will allow for quicker reconciliation, which is really important. For both suppliers and buyers, that means less unnecessary payment delays, which can have a major effect on the whole market, which is really important. Secondly, automation vendors themselves will benefit. Demand will increase for that automation software, and that's a key enabler of that reduced manual work, and that's going to be a big accelerator for revenue for some of those automation vendors this year. And payments companies are also going to benefit from this. By offering instant payments access for corporates and virtual card schemes that are easily managed, payments vendors are going to be able to tap into that demand for increased efficiency, which is really helpful. So ultimately, we predict that these technological capabilities and the shift in attitudes due to the pandemic will result in a significant simplification of those B2B payments processes at large corporates, including increased speed, greater transparency, and really just less manual work being made. Greater use of automation will reduce those burdens businesses face in accounts payable and receivable processes, and those have been highly onerous for a number of years. Those API connections for automation are really critically important here. And technologies such as robotic process automation, RPA, they're going to be critical in enabling the maximum amount of progress to be achieved this year. But we really see big things for this area. So that's it for number 7. So moving on to number 6, which is open banking business models to come of age in 2021. So what's going to happen with open banking in 2021? And there's been a lot of conversation about open banking in recent years. Obviously, the Second Payment Services Directive and features have been massive in Europe. To a large extent, the basic open banking infrastructure was deployed by banks and regulators in 2020. But we believe that in 2021, these business models will begin to come of age and deliver some concrete benefits to end users. Particularly in European markets, open banking infrastructure has been deployed at a decent amount of scale, and banks are offering APIs in line with the provisions of PSD2. Now, there's been a few issues with API availability, but overall these systems are in place. But the critical challenge here is while these systems are deployed and in place, they've to date seen relatively little usage compared to the effort that's been expended on their introduction, and that's really significant. Ultimately, the biggest challenge, which a recent survey we've conducted backs up, is that there is little consumer awareness of open banking to date. And users, if they are aware of it, are generally only aware of the account aggregation capabilities. So that's sort of been a key limiting factor. Now, we predict that 2021 will be the year that those business models mature in this market, and that will allow open banking to become a valuable part of the digital ecosystem in 2021. Now, part of that growth and critical to that growth will be increased user awareness. Banks will prioritise that as part of their marketing campaigns, and that will have a real benefit given their current focus, understandably, on digital experience that we've already heard about earlier in the webinar. We also anticipate that services in open banking will move beyond simple account aggregation, and they'll mature in areas such as advanced financial insights and credit, and we believe those are the use cases where the maximum value can be delivered to that end user, which is really important. Now, why are we going to see this turnaround in 2021? So, fundamentally this year, we believe the correct conditions are now there in place and developing for open banking to achieve success. As we mentioned, infrastructure is already in a good state in Europe, and we've got vendors such as Tink rolling out services on a pretty widespread basis, as well as offering quite an extensive range of value-added services to banks and other financial players throughout that ecosystem. Those capabilities will enable third parties to create compelling applications that leverage open banking to deliver value to those end users. And 2020 was essentially the year in which the industry realized that open banking isn't an end in of itself. It's a key capability, and it's a way to accelerate transformation in banking. It's not the technical capability, it's what you can do with it. And we'll really see that come to life in 2021. And as we mentioned earlier, consumers are more engaged with digital banking than ever due to the impact of the pandemic, and they're looking for ways they can get the most out of their banking experience. Open banking and reducing the complexity in managing their finance is one way in which that requirement can be effectively delivered. So obviously there's going to be benefits from this growth. So the banks will benefit from this. They'll be able to offer more advanced open banking capabilities to their users, and that's going to boost the value proposition by creating that differentiated user experience, leveraging open banking capabilities. That is an additional differentiator for them, which is always very useful, particularly with the market as it is at the minute. Users will have access to a more complete set of open banking capabilities, which is going to be really beneficial. And that'll include aggregation, insights around their accounts, and access to credit. And overall, that provides a better user experience. Third-party aggregators and fintech apps will also benefit as services like Yolt gain traction. Open banking capabilities are at a point where the systems are mature enough for a vendor to access aggregation capabilities which work across numerous banks. So they can focus their efforts on expanding their services in new directions of sort of increasing complexity rather than focusing on the fundamentals. Those are pretty much sorted by now. Overall, we anticipate that this is the year when open banking will come to the fore in banking, and that's going to enable these more advanced services. We think it'll crystallise around that access to credit and those financial insights, because really those are the best ways to use those functions. We'll need to see evolution in terms of monetization around business models, but that will continue to mature as more open banking API providers enter the market and expand the frameworks they offer. So now on to number 5 in our countdown, which is QR code payments to accelerate outside of China and India. So this has been a really dynamic space this year. I think it's a really interesting area. We've already seen that QR code payments have broadened beyond China and India to include other markets, such as Africa and Asia Pacific. We've seen really significant developments. It's starting to make a difference in countries like Singapore and Malaysia, where we've seen national QR code standards being agreed and rolled out. But there's also rapidly growing schemes supporting QR code payments elsewhere. One example is STC Pay in Saudi Arabia. However, that impact to date has been limited in developed markets, and particularly the US there. And the progress there has been limited to a few sort of retailer-specific closed wallets, so there's not been a huge amount of progress there. But our prediction is that this is the year when we'll begin to see significant growth of QR code payment solutions in these more developed markets. And by developed, we almost mean that markets where there's already a broad card infrastructure in place, in particular the US, and that's where sort of contactless has already been a feature of the payments landscape. We anticipate that the US will begin to see significant growth in that QR code payments usage, and that's based on initiatives from several vendors, particularly PayPal here. And we also anticipate beyond larger merchants, QR codes enable users and merchants to accept payments in a much easier way than before. And that leverages these low-cost solutions to displace the traditional role of cash, which has been a real burning issue in 2020 and will continue to be so. So why 2021? We've been talking about QR codes for a while now, so why now? Really, we see that the pandemic has drastically increased the need for simple cashless transactions. Cash's ability to spread COVID-19 has been reported on in several studies, and there's been sort of widespread consumer concerns around its use. That's opened up the opportunity for cashless payments, and contactless payments and QR payments have sort of been fulfilling that requirement. QR code payments are also really easy to deploy, which helps. They offer strong capabilities with limited infrastructure costs. So all that's required is an account with the applicable provider, and then a code can be generated and displayed on a merchant's device, printed off, or even a consumer's code can be scanned from their app. And that simply requires the correct app and a compatible smartphone. So, particularly for smaller merchants, QR code payments are potentially the easiest cashless method to deploy, although contactless payments acceptance with sort of tap-on phone innovation around Android smartphones will begin to close that gap. In addition, PayPal, which we mentioned, has rolled out QR code payment capabilities via its apps to a number of markets, including the US and much of Europe. In the US, the PayPal app, as well as Venmo, has managed to sign up CVS, the national US pharmacy chain, as a partner to accept QR payments in all of its stores, which is really significant. If it can build on that, the prospects for QR payment growth in the market look pretty strong. So this is going to have some effects throughout the space. So consumers are going to widely benefit from these new payment schemes. They allow very simple payments, and critically, loyalty capabilities are included there with QR payments. So there's some value added benefits there. They can provide a very easy way to pay without complexity. And there's also the obvious hygiene benefits of not having to touch surfaces, not having to touch a PIN pad. Those are benefits in the society we live in now. That's really the transformational impact of COVID-19 being witnessed. And for merchants, it's an additional way to accept payments that is easy to facilitate, and it's inexpensive to use and set up compared to NFC-based payment methods, which means that transition from cash is much easier for them to achieve when enabled by QR payments. And they will also gain the ability to link loyalty capabilities direct to payments. So to summarise, we anticipate the overall low cost of deployment and the increasing popularity of smartphones will be particular drivers. PayPal's backing in developed markets as well will be really significant. And that backing is going to be vital to QR payments in Western markets. PayPal is such a big force in e-commerce that if it can leverage that user base, it can scale QR code payments in a way that very few other vendors can. If it can successfully sign up new partners of national importance, it can reach critical mass for users in terms of usefulness, and the US will see significant growth. And we've also seen rumours and potential developments around Apple looking at QR code payments within Apple Pay as well, which would also be highly significant. So I think 2021 is going to be a really important year for QR payments in developed markets. So with that, we are down to number 4. So we're back to Susanna for omnichannel payments and e-commerce to rapidly grow with new payment models in 2021. Over to you.
Thanks very much, Nick. So what's the trend here? Consumer expectations are now such that it's pretty normal to offer payment transactions across multiple channels. Both brick and mortar and online retailers have for quite some time been under pressure to give consumers increasingly frictionless shopping experiences and to meet shopper demand for omnichannel payments. The pandemic has driven a significant global uptick in channel diversification across several verticals, and I'm thinking retail and grocery here in particular, with the rise of order ahead for delivery or collection within restaurants and hospitality. Many food and beverage businesses have been forced to switch their strategy from providing just on-premise consumption to offering only takeaway and delivery via service such as Deliveroo and Just Eat. And so this has very much shifted consumer spend away from the traditional point of sale to e-commerce platforms. And we're also seeing an increased offering of subscription payment models. And these allow products or services to be delivered with minimal interruption. And these have also seen an associated rise in consumer acceptance. So with this expansion of sales channels has come the need for consumers to be able to pay in different ways, using different payment models. And as a result, retailers have really had to accelerate their plans for creating and refining their online presence, as well as having to integrate their brand and checkout in a very effective way. There's been an increasing convergence of channels, with the in-store buying experience moving much closer to the online experience. And that is without the need to produce a physical card or cash, for example, paying with your phone. So this convergence of the physical and digital commerce is driving demand for payments to accommodate omnichannel capabilities. And it really has undoubtedly been a catalyst for the growth of alternative payments too. So why do we see this happening in 2021? Well, the pandemic forced retailers to swiftly pivot to accommodate new ways of operating, minimise the spread of the virus, and also to keep staff and customers safe. Part of this meant they had to implement major changes to their business models to reduce person-to-person contact, but also to ensure minimum disruption to sales while they're doing this. And this has been especially important for those within the restaurant and hospitality industries. So the need to get products to consumers in different ways whilst minimising contact has meant that payments have needed to be taken in different ways. The continuation of lockdown measures to curb the spread of COVID in some markets into 2021 means that this is likely to remain hugely important, and we think it probably will be a permanent change to the way we shop. As consumers have become used to buying goods through these new channels, using these new payment models, their use will continue to grow, as will the need to enable payments in these new ways. So who's going to benefit here? Well, for consumers, the growth of omnichannel offers them more ways to buy what they want and when and where they want it. So for merchants, the shift represents more ways to market and sell products and to drive sales. The role of payments here is going to be key. And so payment providers really do need to rise to this challenge to enable both large and small merchants to continue to operate in this way. Although increased contactless limits have helped to smooth this path and to meet the need to minimise contact, this is really only a small part of what is going to be needed here. The ability to handle payments in an increasingly omnichannel landscape is going to be a key differentiator for both merchants and for payment service providers. Merchants, as I say, will increasingly need to operate in this way in order to compete, to survive, and will need to invest in appropriate solutions to enable them to do this. The larger payment providers are already stepping up to this challenge, but ultimately the solutions offered by the payment providers will need to be completely agnostic to payment models, and as such, they will need to enable payments to be taken across all of the available channels. Another point I want to add here really is one of security. In meeting this consumer demand by offering these multiple ways to buy goods online, the omnichannel experience very much turns into an omnichannel security challenge. Cybercriminals map their strategy to the payment methods on offer, and the challenge, therefore, is not only to have robust authentication methods in place, but also to make sure that all the touch points are really toughened up, including account recovery for all of these available channels. So now I'll move on to number 3, instant payments to begin to reshape money transfer in 2021. So instant payments have made a really strong impact to date, and they pose a significant challenge to the established money transfer models, and we anticipate this trend is going to continue. This is for a number of reasons. They offer a payment method that is far faster than that offered by legacy payment systems. They're free to use, and they offer greater transparency, and this is something that's really been lacking for B2B payments in particular. As a result, established business models within money transfer are at real risk here, and they will need to shift and change as instant payment systems gain traction. A key example is the threat posed by instant payments to some of the digital wallets and money transfer apps. For example, Venmo charges for faster payments, while banks will be able to offer faster instant payments with lower charges. In the US, real-time payments adoption has been relatively steady, but as it scales up, it's really going to bring into focus the business models of these players, like Venmo and Zelle, who charge for these faster payments. I think we're also going to see instant payments increasingly pose a challenge to establish cross-border money transfer models. As these instant payment schemes are introduced globally, they're going to join up to establish cross-border instant payment rails. And clearly this is going to pose a huge challenge to traditional players such as Western Union, who are going to need to overhaul their models in order to stay relevant. And monetization will also be a key challenge to those players as these cross-border remittance services become based on independent systems. And another key point I really want to make here is that this unification of global instant payment schemes is very complex. It's a complex process, and therefore it's likely to take some time to achieve. As a result, we are likely to see instant payments grow more strongly in the domestic money transfer sphere initially. So why 2021? Well, the real-time payment system in the US has been in operation for a number of years now, and its use, mainly for B2B payments so far, has been increasing quite steadily. It was put in place initially by the Clearinghouse Payments Company in the US, a banking association and payments company jointly owned by the larger commercial banks in the US. So its use carries quite a lot of credibility. Another thing I want to mention is that although the FedNow instant payment service is not due to be launched until 2023 or 2024, the Federal Reserve is planning to launch a phased pilot programme, and expressions of interest have already been received from more than 200 financial institutions, service providers and payment processors. So it looks pretty promising. So as I mentioned a moment ago, instant payments are likely to see strongest growth initially in the domestic sphere, although we will see activity in the cross-border payments arena too. Instant payments face similar interoperability issues to other cross-border payment methods at the moment. We're expecting that these barriers between countries for instant cross-border payments will begin to fall significantly as ISO 20022 adoption increases. And as a result, in 2021, we are likely to see the use of cross-border instant payments grow, with initiatives such as Swift's GPI system gaining traction. So who's going to benefit? Well, as we touched on a moment ago, instant payments represent a significant threat to money transfer operators themselves, both to their business models and to their ability to monetize their offering. They offer advantages to businesses. They offer significant improvements in both speed of B2B payments and cost. Also, instant payment schemes offer greater transparency for B2B payments, and this could be a key enabler for automation, something that's urgently needed in B2B payments. So in terms of consumers, some of these advantages also benefit consumers for P2P payments, for example, faster, free-to-use bill payments and domestic P2P payments. So in the domestic payments arena, instant payments represent genuine progress in terms of their capabilities over previous solutions that we've seen. For example, Zelle is slower than a true instant payment, and in order to use it, you need a separate setup process. And this isn't needed with most instant payment applications. And Zelle, as I said earlier, also charges for instant transfers, which actually arrive within 30 minutes and so are actually slower than instant payments. So they charge more and they're actually slower. But there is a twist that is quite important to note here. digital wallets with P2P functions like PayPal are very well established with users, and so they represent really strong competition for these instant P2P payments. Consumer perception is that bank transfers are much slower than these apps, and therefore banks who adopt instant payment schemes, we really recommend that they focus on building out a compelling app experience for their consumers around the faster capabilities of instant payments, and really push this and back this up with large-scale marketing campaigns to users to ensure that their solutions are being leveraged to the greatest extent possible. Now, I'm going to hand you back over to James for number 2. Explosion in e-commerce following pandemic means network-level analytics will be critical to fraud and loyalty in 2021.
Fraud has been a significant challenge that has dominated payments since its inception, and the growth of e-commerce during the pandemic has only intensified it, which has also necessitated the development and implementation of new anti-fraud measures. As the volume of e-commerce payments has gone up, so have the ways that fraudsters are trying to get through and make illegitimate payments. The sea change in consumer behavior means that traditional rules-based anti-fraud measures will struggle to cope with this because everyone's making e-commerce payments for any reason, and there's no real predictive way that can be done with simple rules. And the stopgap measure of many of the solutions that are in place at the moment needs to be patched up and made fit for purpose in the new e-commerce reality. A network-based approach, that's a payments network-based approach to understanding fraud, will be essential to this, which will allow individual merchants to learn from a wider pool of transactions than just their own experiences. For a single merchant that's coming into the e-commerce space and doesn't have any experience of what a fraudulent transaction look like, they can then start to lean on the experiences of their payment network partners to let them know what the flags are for a particular kind of fraud and what makes a transaction fraudulent. These network level analytics will also be highly valuable in loyalty terms because it will allow merchants to analyze card spend behavior and produce not only patterns that can be used for identity verification, but also greater convenience for the end user, because being able to track the card and the card spending patterns will allow merchants to offer customized discounts based on a purchase history without needing to have a distinct loyalty scheme administered, and so have the consumer go through another set of onboarding and another thing to keep track of, and so keep the whole thing very, very streamlined. 2021 will be a key year for this because the volume of data produced by the e-commerce boom in the pandemic is starting to be put to use. With many cybersecurity budgets being refreshed on the turn of the calendar year, we also expect that businesses will now start investing more heavily into technology that they'll need to keep pace with an increased demand on the e-commerce front. The iterative nature of AI machine learning also means that this year we'll see full implementations of the new patterns that have come from this increase get used into fraud detection. Now that the models have had a holiday season of data to harvest for their models, and it's not only a holiday season, which is a traditional uptick anyway, but it's a holiday season where vast amounts of things that would have been got in store have now been made into e-commerce transactions. And so there's a bumper crop of data for AI to benefit from. And in terms of other beneficiaries, we expect card networks and other payment data processors to benefit directly from the trend, as the providers can use the data to offer value added services based on a synergy between fraud and loyalty, as we've already spoken about, which will help extend their reach. And it will also help them retain their customers in particular if they can provide distinct loyalty services that aren't available through their competitors. Smaller merchants can use these tools to scale up their operations with loyalty tools through their payment network provider, and that in turn will help them retain customers. The key to that will be making customers aware of these capabilities and their benefits, letting the consumer know what's going on, how their payment details and data are being handled will be key to making people comfortable with this arrangement. If you suddenly have something pop up and say, oh, we noticed that you've bought this particular brand of washing powder for the past 3 months, here's a discount, and you don't actually sign into an account anywhere, people are going to get suspicious. So keeping people on board with how their card details are being used is going to be key. But thanks to these new technologies, we anticipate that the growth in spend on e-commerce anti-fraud measures will double from 4% to 8% growth over 2021, which will result in over $9 billion worth of spend on anti-fraud technology by the end of the year. This increase is expected to come not only from security budgets, but it will also expand because the purview will get a little broader. Because you can fuse it with loyalty, it means that you can also pull from customer relations management and other areas, because the same technology will become invaluable for both aspects of online business. And now back to Susanna for our number one trend for 2021, that there'll be a dramatic rise in buy now, pay later purchases in 2021.
Thanks very much, James. So, buy now, pay later is a payment model that lets consumers defer payment for online purchases, either paying the whole balance at a later date or by splitting the costs into equal instalments. So it's a significant shift away from the credit card model of consumer financing, and it gives greater flexibility to consumers. It removes the need for credit approval other than the soft checks carried out by companies offering the model. And we're now seeing it being offered for in-store purchases. Buy now, pay later has seen increased use as a way of paying for goods online, with a growing number of merchants offering it as a payment method. It's already being offered by companies such as Klarna, PayPal, and these companies take on the credit risk, merchants being paid the full transaction amount straight away. Other retailers, like UK fashion brand Next, offer their own interest-free instalment payment plans and even offer discounts on first purchases when their customers use the scheme. So, as we've already discussed quite heavily, the pandemic has accelerated what was already a growing trend towards online shopping. Many consumers have had less chance to spend their disposable income on travel and leisure, and as a result have had more to spend online on non-essential items. Buy now, pay later market leader Klarna has claimed that brands with instalment financing have seen an increase of 58% in average order value and an increase in 30% in conversion rates. So with the continuation of lockdown measures lasting into 2021 and this continuing shift towards shopping online, we are likely to see a further increase in the use of buy now, pay later in 2021, with a growing number of merchants offering this as a payment model. So the use of this model in e-commerce is a major shift away from the traditional fee and APR-based credit card models of consumer financing for online purchases, and it is one that may be particularly appealing to a younger demographic. Klarna's strategy to charge no fees to merchants and effectively offer interest-free credit to consumers is a compelling one. And with players such as PayPal entering the market, we are likely to see a sharp rise in its use. So who's going to benefit? Well, the buy now, pay later model offers a way to help merchants drive sales, increase basket sizes without additional credit risk, and merchants are paid in full at the time of purchase. Additionally, it can be a way to encourage repeat purchases, and Klarna has reported a 20% increase in purchase frequency from customers using this method. It offers consumers a flexible, interest-free way to spread the cost of purchases while sticking to a fixed budget. One commonly cited reason for abandoned carts is price, which does mean that there are clear benefits to offering consumers the ability to split the costs, particularly for those higher value purchases. So we at Juniper Research, we expect that the shift towards e-commerce and this huge rise in m-commerce that we're seeing will lead to the rapid growth of new payment models such as buy now, pay later. We're also likely to see an increase in partnerships and consolidations to allow these payment models to be offered. For example, in September 2019, buy now, pay later provider Sezzle announced that it would be using Visa's Cybersource payment management platform. And there's also really strong potential for this model to lead to the decreased use of credit cards, offering a real alternative to the fee and APRs that come with their use. The potential here is this may mean a permanent shift away from plastic cards, with millennial purchasing power likely to increase further as this demographic gets older. An important point to make here is the increasing calls for regulation. Unlike the payment card market, up to now, the buy now, pay later market is by and large unregulated. It undoubtedly makes it easier for consumers to take on credit, but with that comes the associated risk of increasing debt. And Klarna has itself voiced support for stronger regulations in this area. And today it was announced that the Financial Conduct Authority in the UK plans to regulate buy now, pay later agreements with the purpose of protecting consumers. So it remains to be seen how and when such regulations will come into effect in other markets. Companies offering buy now, pay later will need to show that they're heeding these calls to protect consumers. Payment processors are going to need to prioritise building their technological ecosystems to allow the acceptance of buy now, pay later across all payment methods, or they're going to be left behind by more digitally adept payment providers. And now I'm going to hand back to Nick for a recap of the rankings 1 to 10.
Thanks, Susanna. That wraps up our top 10 fintech trends and predictions for 2021. Let's just have a quick recap of those rankings. So we discussed right at the start how digital onboarding is maturing rapidly, AI being critical to banking user experience. Then we outlined how social commerce is advancing quickly, and that was followed by transparency and speed rising in B2B payments. At 6, we had open banking business models to come of age in 2021, followed by QR code payments to accelerate outside of India and China at 5. At number 4, we explained how omnichannel payments will rapidly grow with new payment models, with instant payments beginning to reshape money transfer at number 3. At number 2, we discussed how network-level analytics will be critical for fraud and loyalty. And at number 1, we highlighted how buy now, pay later will rise in 2021. So that brings us to the end of our webinar. Hopefully you found it insightful. As mentioned earlier, we'll make a recording of this available on our YouTube channel and on our website, following which we'll publish a more in-depth white paper, which will analyse and break down those trends a bit more for everyone. Please feel free to browse our website and you can see all of the reports we produce there. And if you need any further assistance, you can contact us directly on the details below or reach out to any of the team. So with that, all that's left to say is thank you for joining us. We appreciate your time. We hope you found it useful. And we will say goodbye for now. Thank you very much.